While Trump was busy slapping tariffs, Canada was planning a surprise, one pipeline at a time. Billions are now flowing east, not south. And if this deal with Europe goes through, the United States won't just lose its closest energy partner, it could lose control of the entire continent's gas market. On January 22, 2025, during an off-the-cuff press conference, President Trump said, "If Canada thinks it can push us on trade, maybe it should find someone else to buy its oil." The moment was buried beneath headlines about tariffs on China. But to Canadian officials, it landed like a gunshot at point blank. Within hours, Ottawa's Ministry of Energy went into emergency talks with Shell Canada, Suncor, and the Canadian Association of Petroleum Producers. A leaked internal memo obtained by the Globe and Mail warned of strategic rebalancing away from the U.S. export corridor, citing the risk of volatile executive-driven policy. Trump's one-liner didn't just insult an ally. It exposed a structural weakness in America's entire energy strategy, and Canada was already sketching the blueprint for a workaround. But how did a single remark flip the script on a 50-year partnership? And why was Europe already waiting with open arms? The retaliation didn't come in the form of counter-tariffs or fiery speeches. It came in spreadsheets, boardroom calls, and port construction timelines. In February 2025, Canada's Minister of Natural Resources Jonathan Wilkinson quietly flew to Brussels, finalizing a €1.6 billion framework with the European Commission for expanded LNG trade, according to Bloomberg Energy. The agreement outlines a new supply route via the St. Lawrence River to serve Germany, Poland, and the Netherlands. Meanwhile, Reuters reported that Canadian crude exports to the United States dipped 5.4% in Q1 2025, the sharpest quarterly decline since 2020, while exploratory shipments to Spain and Italy hit a record high. As University of Ottawa energy economist Monica Gattinger noted, this isn't a protest. It's a calculated exit strategy. And it's not just about oil. Canada's strategic pivot includes critical minerals, LNG, hydrogen, and even power grid tech, all aimed squarely at EU demand. But the real pivot point? Infrastructure. Without new routes, rebalancing is theory. With them, it's insurgency. For decades, Canadian pipelines moved in one direction, south. Over 95% of Canadian crude exports still flow to U.S. refineries, according to the Canada Energy Regulator. But that chokehold is loosening. The $40 billion LNG Canada project, led by Shell and 5 Asian partners, is set to begin operations by mid-2025, opening Canada's first direct link to Asia. In tandem, the Trans Mountain Expansion Project, adding 590,000 barrels per day in westward capacity, is nearing full commercial deployment. Together, these projects increase non-U.S. export potential by over 75%. In eastern Canada, momentum is building behind the long-dead Energy East pipeline. Revived under new branding as the Atlantic Energy Corridor, the project now has backing from Irving Oil and European investors, with preliminary environmental approval fast-tracked in New Brunswick. Financial Times reported that the EU has pledged €800 million toward Atlantic port modernization if Canadian exports can hit 500,000 barrels per day by 2027. The infrastructure once built to feed American demand is now being rerouted to bypass it entirely. But the question remains, why is Europe suddenly betting so heavily on Canada? Europe's energy crisis didn't end with Russia's pipeline cuts. It just changed form. In 2024, the EU imported 39% of its LNG from the US, up from 28% the year before. But that dependence is becoming politically fragile. In January 2025, President Trump froze new U.S. LNG export permits, citing domestic energy security, according to the Wall Street Journal. Within a week, natural gas futures in Europe spiked 12%. Canadian LNG offers a hedge-stable governance, low flaring emissions, and 20-year contract potential. In March 2025, Germany's economy ministry signed a provisional LNG import agreement with Pieridae Energy, aiming to receive 1.3 million tons annually by 2028 through a yet-to-be-built Nova Scotia terminal. That deal alone could displace 12% of Germany's current US LNG imports, based on Eurostat figures. Kadri Simpson, EU Commissioner for Energy, said in a Brussels presser, "We view Canada not as a backup supplier, but as a primary partner in reshaping European energy independence." The language is clear. This isn't a diversification strategy, it's a courtship. But is Canada truly ready to fill the gap Russia left behind? Russia exported 155 billion cubic meters of natural gas to Europe in 2021. By 2024, that figure plunged below 40 BCM. The IEA projects that by 2030, Russia's role in Europe's gas mix will shrink to below 10%. That void is immense, and Canada is building the scaffolding to step in. With LNG Canada projected to ship 14 million tons annually and additional Atlantic capacity planned at Goldboro and Bear Head, Canada's total LNG exports could surpass 30 million tons by 2029. For context, that would equal about 40% of current Russian exports to Europe. But it's not just volume, it's alignment. Unlike Qatar or Algeria, Canada's trade policy is fully synchronized with EU climate goals. New facilities include carbon capture commitments, methane leakage caps, and Indigenous equity participation. According to Wood Mackenzie, Canadian LNG projects may command a 10% premium per ton due to ESG compliance, yet buyers aren't flinching. Still, the biggest disruptor might not be gas at all. It's what Canada does next, with hydrogen, rare earths, and battery metals, that could turn this energy realignment into a geopolitical reshuffle. So here's the question. If Canada becomes Europe's go-to supplier, does that make America expendable? Let's talk about it. Drop your thoughts in the comments, because what happens next could reshape global alliances. So, why are Canadians rallying behind a pipeline that was once dead? Once the symbol of environmental resistance, the Energy East pipeline is now back in the spotlight, and the politics around it have flipped. A new poll by Angus Reid in March 2025 shows 64% of Canadians now support building new eastward energy corridors, up from just 42% in 2021. The shift isn't ideological, it's economic. According to a report by the Canadian Energy Regulator, if Canadian crude is rerouted to Atlantic ports, it could increase national energy revenues by up to CAD 13.2 billion annually, while reducing reliance on volatile U.S. trade policy. The Revive project, rebranded as the Atlantic Energy Corridor, has secured exploratory capital from Germany's Uniper and Spain's Enagás, with federal environmental reviews being fast-tracked under Bill C-42, passed in January. Even Quebec Premier François Legault, once a vocal opponent, stated in a joint press conference, "This is no longer about politics, it's about sovereignty over our exports." But as support surges, critics warn the momentum may outpace regulation. So who stands to lose the most if the pipeline moves forward? If Canada redirects even a fraction of its crude away from the US, the impact will be felt immediately, and not in Ottawa. As of the fourth quarter of 2024, the US imported 3.72 million barrels per day from Canada, according to the US Energy Information Administration, accounting for more than 56% of all US crude imports. A 10% reduction as projected by RBC Capital Markets if the Atlantic Corridor opens by 2027. Could cut daily U.S. supply by 370,000 barrels, enough to send Brent crude prices up by $4 to $6 per barrel, according to S&P Global. Refineries in the Midwest and Gulf Coast, which were built to process heavier Canadian crude, are especially vulnerable. In 2022, a brief disruption on the Keystone Pipeline due to a leak led to a 21-cent jump in U.S. gasoline prices within 4 days. The Department of Energy now warns in its 2025 first quarter briefing that pipeline route diversification by Canada poses a strategic challenge to U.S. refinery capacity planning. But the bigger story isn't just about price spikes, it's about leverage, and Canada is starting to use it. Canada is no longer waiting to be invited to the global energy table, it's bringing its own chair. With LNG Canada set to ship 14 million tons annually starting in the third quarter of 2025, and Woodfibre LNG preparing for operations by late 2026, Canada's total export capacity could exceed 27 million tons by 2027, according to the International Energy Agency. That would rank it just behind Australia and the US, placing it third globally in LNG export volume. But volume is only half the story. Canada's energy strategy now includes long-term contracts with ESG-linked premiums, giving it an edge in European and East Asian markets increasingly pressured by climate standards. Bloomberg NEF data shows that Canadian LNG can command up to a 12% premium over U.S. cargoes due to lower methane emissions and First Nations equity participation in key projects. At the same time, Ottawa is finalizing a national clean hydrogen framework designed to tie future exports to decarbonization mandates, making energy diplomacy a two-pronged strategy: revenue and regulation. So if Canada plays this right, it doesn't just supply fuel, it sets the terms. But will Washington allow that autonomy to stand? Since 1974, the US and Canada have operated under the principle of integrated energy security, reinforced by NAFTA and codified in the 2019 US-Mexico-Canada agreement. But Trump's public threats in 2025, combined with the halt on new LNG export approvals and steel tariffs reimposed under Section 232, have effectively frozen that partnership. According to a leaked briefing obtained by the Washington Post, Canada's National Energy Board warned the Prime Minister's office that U.S. policy under Trump has created significant sovereign exposure and recommends accelerating diversification of energy export markets. The Financial Times reported last month that Canada is in early-stage discussions with the EU Commission for a broader strategic energy partnership, modeled after EU-Norway cooperation, that would bypass Washington entirely on key contracts. Chrystia Freeland, in a March 2025 address to Parliament, said plainly, "Canada will not be used as a pawn in unpredictable foreign trade policy. We are no longer simply an exporter, we are a negotiator. But the bigger question isn't whether the alliance is cracking, it's whether this breakup was inevitable all along." Canada isn't just retaliating, it's rewriting the rules. While Washington lobs threats and tariffs, Ottawa is building corridors, drafting EU contracts, and securing ESG premiums that didn't even exist 5 years ago. The balance of energy power is shifting, not through dramatic standoffs, but through silent strategy, market math, and infrastructure quietly rerouted eastward. Trump may have sparked the move, but the tracks were already laid. So what happens when an ally becomes a competitor? What happens when Europe treats Ottawa as a partner and Washington as a variable? And here's the twist most Americans aren't ready for. If Canada completes its pivot, China might not be the next big supplier Europe turns to. Canada will. But how long can Canada walk this line between two superpowers before it's forced to pick a side? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.